All right, let's just jump right into one of the biggest, most confusing puzzles in the world today. We're talking about the great disconnect, why it often feels like the stock market is throwing this huge party that, well, the rest of us definitely weren't invited to.
I mean, you see the news, right? Markets hit another all-time high. But then you're at the grocery store and you see the prices. Or you hear about friends worrying about their jobs. It's this crazy disconnect that makes you stop and wonder, wait, are these two things even connected anymore? Well, today, we're going to get to the bottom of it.
So to really solve this mystery, we first have to get to know the two main characters in our story. And you have to understand, even though they're on the same stage, they are living in completely different worlds. We're talking about the real economy and the stock market.
Okay, this chart really nails the whole problem right here. The real economy, where you and I live and work, is all about what's happening right now. It's about jobs, our paychecks, making actual things. And it moves pretty slowly. But the stock market? It's a completely different game. It's a high-speed betting machine totally obsessed with the future. It's all about what investors think is going to happen, and it can change its mind in an instant.
So, let's be super clear about this first world. The real economy is the stuff you can actually touch and feel. It's the local pizza place, the car factory down the road, your actual salary hitting your bank account. It's all measured by things we really experience, like how many people have jobs or how much stuff our country is actually producing.
The stock market, though, is a whole other animal. Think of it like a prediction engine. It's not asking, how are things today? No way. It's asking, how much profit are the biggest companies in the world going to make 6 months or even a year from now? And that is the absolute key. Its laser focus is on future corporate profits, not how we're all doing in the here and now.
Okay, so now that we know who our two players are, it's time to put on our detective hats. We're going to follow the money because that's going to lead us to the three hidden forces that are really prying these two worlds further and further apart.
And the first, and honestly the most powerful force, is money itself. Specifically, that giant river of cash that gets created by central banks. Where that river flows, that is the #1 clue to solving this entire mystery.
So here's how it works. When the economy starts to look a little shaky, central banks basically turn on the money spigot. They lower interest rates, they print money, they create what's called easy money. But here's the catch. That money doesn't just show up in your paycheck. Oh no, it floods the financial system first. It goes to the big banks and investment funds. And what do? They buy assets. They buy stocks. And that pushes stock prices way up, long before a single penny ever trickles down to help a small business or boost a salary.
Now for our second force. It's all about who the stock market is really talking about. It isn't the economy as a whole. It's actually a pretty small exclusive club of gigantic publicly traded companies. And trust me, these giants are playing a totally different game.
I mean, just think about it for a second. When times get tough, how can a massive corporation actually increase its profits? Well, they can cut jobs and bring in automation. They can raise prices because we have fewer choices of where to shop. The stock market loves this. It sees those fatter profit margins and cheers. But for the rest of us, in the real economy, that just means fewer jobs and things costing more. The market is rewarding pure profit, not widespread prosperity.
And that brings us to our third and final clue. It's a really clever piece of financial magic called a stock buyback. And this is a huge reason why stock prices can shoot for the moon without a single thing of real value being created for the economy.
So instead of using all that profit to, say, build a new factory or invent a new product or give everyone a raise, a company can just buy its own stock off the market. Simple, right? But what that does is it reduces the number of shares out there. And basic supply and demand tells us that when supply goes down, the price of what's left goes up. And this is the disconnect in a nutshell. The stock price soars, but the company didn't sell a single extra product or hire one new person. It's pure financial growth, not real economic growth.
Okay, we've got our clues now. We have easy money, we have concentrated corporate power, and we have stock buybacks. So now let's put the puzzle pieces together and solve the big paradoxes that make all of this so confusing.
Right, this is the big one. The economy is in the tank, people are losing their jobs, so why in the world is the stock market going on a bull run? It makes absolutely no sense. Or does it?
Here's the secret. The market isn't reacting to the bad news, it's reacting to what it knows is coming next. Investors see a struggling economy and they think, aha, I know what this means.
The central bank is about to crank up that money printer. They're basically front-running the easy money that we now know flows right into stocks and pushes prices up. They're not betting on the disease, they're betting on the medicine.
But what about the flip side? Sometimes everything seems great. We hear about strong job numbers, a healthy economy, and then, boom, the market takes a nosedive. What is going on there?
It's the exact same logic, just running in reverse. When the economy starts doing a little too well, investors get spooked. They worry the central bank is going to step in and raise interest rates to cool things down. And higher rates mean it's more expensive for companies to borrow money, which makes their future profits worth less. So even if the economy is humming along today, the market sells off because it's afraid the easy money party is about to be over.
So what all this really means is that we need a new way of thinking about this. We just have to stop looking at the stock market as a report card for the real economy. Because, frankly, it's just not anymore.
This quote right here just says it all. The market has basically become a barometer for financial weather. It tells you about liquidity, how much cash is sloshing around the system, and it tells you about the policies controlling that cash flow. It is no longer a reliable signal for the economic health of the average person.
And you can see that shift perfectly on this table. The stock market today is absolutely obsessed with what central banks are going to do, with tiny changes in interest rates, with credit conditions. What it cares a whole lot less about, things like our wages, our actual standard of living, or the health of the small businesses that are really the heart of our communities. If you take away just one thing from all of this, let it be this right here. The real economy is about putting food on the table. It's about survival. The stock market is a completely abstract game of predicting future numbers on a spreadsheet. It's about valuation. They are two different worlds, driven by totally different forces. And understanding that difference, well, that's the key to making sense of it all.